Do private equity firms invest in real estate? When people think of private equity, they think of these billion-dollar company buyouts. But do they invest in real estate? When you think of private equity, you may think of billion-dollar company buyouts. But believe it or not, private equity is buying up real estate all over the country. In this video, I'll show you why and how you can invest just like them. Most people assume private equity only invests in businesses. But the truth is, real estate is one of their biggest plays. I'll break down exactly why private equity invests in real estate and why that matters to you as an investor. If you've ever wondered, do private equity firms invest in real estate? Then stick around. I'll show you how they structure their deals, what type of real estate they focus on, and how you can invest alongside them. By the end of this video, you'll know exactly what type of real estate private equity wants to invest in, how they like to structure their deals, and how you as an investor can invest alongside them or benefit from their strategies. So the question is, do private equity firms invest in real estate? Well, the answer is yes. Private equity firms invest heavily in real estate because it offers 1, strong cash flow, 2, long-term appreciation, and 3, tax benefits. In fact, some of the biggest investors in the world are private equity firms. Firms like Blackstone, they're the largest real estate private equity firm globally. Brookfield Asset Management, they invest in commercial, industrial, and residential properties. The Carlyle Group, they have diversified real estate investments across all asset classes. And of course, Patriot Holdings, my private equity firm that is not even close to the size of those guys. So how private equity firms structure real estate investments? Private equity firms raise money from passive investors or limited partners, LPs. They use this capital as a pooled fund structure where they'll go out and acquire, improve, develop assets that they will position eventually to sell. The goal when holding these assets is to improve operational inefficiencies. So it's driving revenue, decreasing expenses, and targeting assets that are in larger macroeconomic growth cycles. They want to focus on recession-resistant assets and assets that inflation will help improve the value of the asset. This is how private equity firms generate higher yields than the stock market, because it's a hands-on approach to investing. It's not passively investing in an institutional, stabilized asset that doesn't have any inefficiencies. After holding the assets for 5 to 10 years or whatever the fixed period of time is on the asset, that's when the profits are then generated by selling off or exiting the assets and then distributing those funds into the partnership for the limited partners and the general partners to share in. In a traditional private equity structure, there is a preferred return that is paid out to the LPs, the limited partners. The limited partners put up all the money, the general partners manage the properties, typically get the debt on the properties, and actively participate in finding those deals. Once cash flow comes in from the investments, the investors are paid back their accrued preferred return. So quality funds to invest in are ones when the investor makes their investment, the preferred return starts accruing immediately. A preferred return means that it doesn't pay down the investor's capital account. So if it's an 8% preferred return, like we do here at Patriot Funds, then the $100,000 that the investor invested now generates an $8,000 a year preferred return that doesn't pay down the capital account balance that the investor invested. As cash flow comes in, that pays down the 8% preferred return. And then when an asset sells, the investor gets their return of capital, the remainder of what hasn't been paid on the preferred return, and then a split of the profits. At Patriot, we do anywhere between a 70 and 80% split to the limited partners, meaning they get the majority of the profits from the sale, and then the general partners, us and my team, we would get 20 to 30% of that asset. There's a wide variety of structures in private equity funds. You can find as low as a 50-50 split with investors up to a 90-10 split with the investors getting the favorable terms. There is no one structure that fits all in private equity, so be sure to do your diligence and homework, seeing what the profit sharing split is, what are the preferred equity terms, and is there a catch-up provision in that private equity offering? Meaning, does the sponsor get to pay themselves back a share of the profits that the investors took on the preferred return payments so that the sponsor gets to catch up or equal what those payments are to the preferred return, and then you split in the profits. This dramatically affects the investor's returns because the sponsor gets to catch up or take back all those profits that he paid out in preferred returns. This is somewhat of a complicated structure, and I will in future videos break down the difference between catch-up and non-catch-up funds, and what a preferred return is. What type of real estate do private equity funds invest in? Well, almost all types of real estate. During different economic cycles, different asset classes are more sexy than others. So I'm going to break down all the asset classes private equity firms love to invest in. Apartments. Apartments are recession resistant, yet the yields are very low. Private equity firms love apartments, but they can be risky due to the fluctuation of the debt. Many times they buy these assets on non-fixed or variable rate interest rates. And as interest rates have shifted over the last 18 to 24 months in 22 and 23 and 24, this has really affected the returns on apartment investments in private equity funds and created a lot of fear and volatility. And some of these funds have actually gone out of business because of this interest rate risk. Industrial and small bay warehousing. Industrial properties have been booming the last few years and have cooled down the larger industrial properties in some of the core markets over the last 12 months in 2024 and early 25. But small bay industrial has a high demand. There seems to be a high demand for e-commerce and home service businesses, and many of the trades that need small spaces to work out of running their companies. It is a very sexy asset class right now. Self-storage. Self-storage has cooled off over the last year in 2024, yet it's recession resistant. There's high profit margins and it's a consistent cash flow. Private equity and public firms do like these assets. Mobile home communities. Recession resistant, very low turnover and very limited supply, and it solves the affordable housing problem. The problem is with the assets, they've been overvalued over the last 12 to 24 months, but there's still high demand for these investment assets. These assets have a wide variety of quality in the types of mobile home communities there are. Not all are treated equally. Institutions or private equity firms that are more sophisticated are going to target quality assets that are 3, 4, 5 stars, meaning that they're in retirement communities, bigger markets, higher quality homes. And some of the smaller private equity firms are going to focus on older, mismanaged, damaged mobile home parks that are targeted in more rural areas and focus more on affordable housing. Office and retail. There are private equity funds that still focus on these types of assets. They are the traditional types of real estate investments. Office properties have been severely struggling over the last 5 years post-COVID, so be careful if you're investing in a private equity office fund strategy. Hospitalities and resorts. This is an opportunistic play based on tourism and business travel. Be careful, this is highly driven on the sponsor, and they're going to need to be able to operate these properties efficiently and effectively in order to drive revenue and make the fund profitable. At Patriot Holdings, we focus on the 3 that we know best: self-storage facilities, mobile home parks, and small bay warehouse. These are mismanaged assets that we can aggregate together and roll up or put together in a larger fund structure and ultimately sell at some point down the road, where we've improved value, raised revenue, made the capital improvements, and ultimately drove more profit margin to our fund and to the next buyer who's going to acquire them. Why private equity firms prefer real estate over stocks and bonds? So number 1, more control. Unlike stocks, private equity has a hands-on approach to investing, and they have control over the assets, improving the business or improving the operations and driving more yield to the investor. Cash flow and appreciation. Unlike stocks, properties generate rental revenue and with inflation continue to increase that revenue, which ultimately creates long-term appreciation. Leverage benefits. Many times stocks do not have a lot of leverage or debt on the assets. In private equity funds, they leverage debt and get up to 50, 60, 70% leverage, accelerating returns to investors by getting low interest debt and finding high yield businesses or real estate to invest that debt into. Real estate allows for tax-deferred exchanges, for depreciation losses, and for long-term capital gains tax strategies. Tax advantages are a large part of why wealthy investors love to invest in private equity real estate funds. So now I'm going to look at the differences between private equity investment and real estate investment trusts, or REITs. REITs are public investments that you can buy on the public stock exchange. So here are the pros and cons and differences between the two. So private equity real estate, ownership. As an investor, you get direct asset ownership. You actually own a piece of each property in the fund. Public REITs, you buy a share in the company that owns the assets. You don't have direct access to ownership of the assets. Liquidity. Private equity is illiquid. You need to hold for 5 or 10 years before you can sell or get your capital back from the investment and your returns. Liquidity for public shares, high. You can trade your stock any day, any night, and get your cash back from that investment. Returns. Private equity historically has higher potential returns, 14 to 18%. Public REITs have stable but lower returns, anywhere between 6 and 10%. So who should invest in private equity real estate? Investors looking for higher than market returns and tax advantages with their investment. Also, those who can commit to longer investment periods and be patient in their timeline. So here are the steps on how you can invest in private equity real estate. Step 1, determine if private equity fits your real estate goals. Step 2, decide if direct ownership in you buying the property yourself, or 2, investing in syndications or partnerships, or 3, investing directly into a real estate fund, or 4, investing in a real estate investment trust is the right vehicle for you. Step 3, if you're investing in a private fund manager, vet the sponsor. Do they have a good track record? Look at that track record and get references. Is the timeline conducive to what you're looking for in investment? Are your interests aligned? Do they invest alongside you so they have skin in the game? And lastly, how do they communicate? Are they transparent around communication on the investment, if it goes good or bad? These are important key points to know when investing with a sponsor. Lastly, make the investment and let the professional investors operate for long-term growth and cash flow. If you're thinking about investing in private equity real estate and you want to get high cash flow returns, I have a free gift for you. It's the Essential Guide to Passive Real Estate Investing. Inside, I'm going to break down the 10 keys of what you must ask an investment sponsor so you know what's going on with your investment and if it aligns with your goals as an investor. Things like, what fees do you charge? What is the timeline of the investment? Who has decision rights? How are the profits getting split amongst the partners? And what is the waterfall or the order of payback of the profits? We're going to give you this checklist so that you are not blindsided and you know exactly what you're investing in. So click on the link below in the description and get that free guide, and feel free to call me at Patriot Holdings. I'm happy to answer any of your questions if you are focusing on investing in private equity real estate like a pro.